Bitcoin just moved back above $70,000, and that sounds like a victory until you realize what it's actually saying. As of today, BTC is around $71,254 after rebounding sharply from recent weakness. But this move did not happen in a vacuum. It came right after a major geopolitical shift: the sudden easing of US-Iran tensions and a ceasefire framework tied to the reopening of the Strait of Hormuz. In other words, one of the world's most volatile assets just surged because a global crisis looked slightly less dangerous. And that is where the story gets interesting, because people still want Bitcoin to be one simple thing: a hedge, a safe haven, digital gold. But when you watch what it actually does during real stress, the truth is messier and much more revealing. A lot of people expected the opposite. If the world feels unstable, shouldn't Bitcoin rise because it protects you from instability? Sometimes, yes, but not in the clean textbook way people imagine. Over the last several weeks, Bitcoin was not behaving like a pure panic shelter. It was trading inside a broad range while the Iran conflict intensified, and earlier this year it even fell hard with other risk assets, dropping below key levels during a wider market rout before later bouncing back above $70,000 as tech stocks and broader sentiment stabilized. Reuters also noted this week that Bitcoin was back above $70,000 as broader market noise started calming down. That matters because it suggests this latest move is not just about fear. It is about the market repricing risk, liquidity, and probability all at once. And here's what people don't realize: Bitcoin often rallies not when the world is simply bad, but when uncertainty begins to narrow. That is a very different psychological environment. When investors face open-ended danger, they usually move toward cash, short-term bonds, or whatever feels immediately liquid. But when a crisis shifts from "this could spiral" to "maybe this gets contained," the brain changes gears. This is where present bias and narrative investing show up. Investors stop focusing on immediate damage and start reaching for upside again. That is exactly why Bitcoin jumped when the ceasefire headlines hit. The market was not celebrating peace in some abstract sense. It was repricing the chance that oil shocks, inflation spikes, and broader financial stress might not get as bad as feared. Bitcoin benefited because relief tends to revive appetite for volatile assets very quickly. But this is where the story changes again. If Bitcoin is rising on relief, why do so many people still call it digital gold? Because Bitcoin now lives in two worlds at once. One part of the market sees it as a scarce, non-sovereign asset outside the traditional system. Another part treats it like a high-beta macro trade that responds to dollar weakness, liquidity, and sentiment. Reuters captured both sides over the past 2 years. In 2024, spot Bitcoin ETFs were approved in the US, opening the door to mainstream capital and giving Bitcoin a more institutional pipeline. That approval helped change how money enters the asset. Then the April 2024 halving cut new supply issuance again, reinforcing the scarcity story. Later, Bitcoin surged through 2024 and 2025, helped by ETF enthusiasm, institutional adoption, and a weaker dollar, eventually climbing above $120,000 and later setting a record above $126,000 in October 2025. So yes, the digital gold narrative exists, but at the same time, Bitcoin has repeatedly traded like a risk asset when liquidity is tight or macro stress gets ugly. That dual identity is the real story. Bitcoin is not failing because it reacts to global events. It is maturing into something more complicated. Think about what happened this year. In February, Bitcoin suffered a brutal sell-off, at one point sinking toward the low $60,000, with Reuters describing a massive crypto washout and heavy liquidations. Then, within days, it could rally back above $70,000 when broader risk appetite recovered. By March, but Citigroup was still bullish enough to keep a base case 12-month target of $112,000, even after cutting its forecast from $143,000 because U.S. crypto legislation had stalled. Citi's range was wide, around $58,000 in a bad macro scenario, up to $165,000 in a strong demand scenario. That is not the profile of a boring store of value. That is the profile of an asset sitting at the intersection of scarcity, speculation, policy, and global liquidity. And this is why the move above $70,000 matters more than the number itself. 70,000 is not just a price. It is a psychological border. Reuters referenced it multiple times this year as a key line traders were watching. When Bitcoin broke below it in February, the mood turned ugly fast. When it reclaimed it, the tone changed again. Markets love round numbers because humans do. They become emotional anchors. Once that anchor is lost, people imagine deeper downside. Once it is recovered, people start rebuilding conviction. This is classic mental accounting. Investors do not treat $69,800 and $70,200 as nearly identical. They treat one as weakness and the other as confirmation. That sounds irrational, but it is how real markets work. Numbers become stories, and stories become flows. There is another layer here that most people miss. Bitcoin is now reacting not only to crypto-specific news, but to the same macro forces that move currencies, oil, tech stocks, and bond yields. Reuters noted both in 2025 and 2026 that Bitcoin's strength often coincided with dollar weakness and improving appetite for risk. That means Bitcoin's price is no longer just a referendum on crypto belief. It is increasingly a referendum on the broader financial mood. If the dollar softens, if rate cut hopes rise, if tech rebounds, if geopolitical stress eases just enough, Bitcoin can benefit. That does not make it fake. It makes it integrated, and integration changes the psychology of ownership. People no longer buy Bitcoin only because they believe in decentralization. Some buy it because it has become part of the global macro chessboard. But here is the uncomfortable part. Even after this rebound, Bitcoin is still far below its 2025 record above $126,000. to $26,000. So the move back above $70,000 can be read in two completely different ways. To believers, it is proof that the asset refuses to die, even after panic, war headlines, and regulatory delays. To skeptics, it is evidence that Bitcoin is still mostly a volatile sentiment machine dressed up in a scarcity narrative. Both sides have evidence. That is why this asset keeps pulling people back in. It is not simple enough to dismiss, but not stable enough to fully trust. And that tension is exactly what keeps attention on it. This part is important. The latest rally does not just tell you something about Bitcoin, it tells you something about investors. In moments like this, markets become less about spreadsheets and more about emotional sequencing. First comes fear. Then comes stabilization. Then comes the hunt for assets that can move fastest if the worst-case scenario fades. Bitcoin thrives in that third phase. It is too volatile for the first phase and too controversial to ever feel fully safe. But once traders sense that the panic window is closing, it becomes attractive again precisely because it can move so violently. That is why Bitcoin can behave like a risk asset in a crisis and still keep the long-term mystique of digital gold. People are not choosing between those narratives cleanly. They are switching between them depending on what the world feels like this week. So what actually happened when Bitcoin jumped back above $70,000 after a major global event? The simple answer is that traders saw a sudden drop in geopolitical tail risk and rushed back into volatility. But the deeper answer is that Bitcoin has become a mirror for modern financial psychology. It reflects fear, relief, scarcity, liquidity, and identity all at once. It can be a macro trade, a belief system, a momentum asset, and a hedge against the system depending on who is buying it and why. And that is why every big move in Bitcoin feels bigger than the chart itself. You are not just watching price. You are watching a live argument about what money, risk, and trust are supposed to look like in a world that keeps getting more unstable. Subscribe if you want to understand the system behind the moves, not just the price.